Night, and it's one of two chapters that deal with how does a company come up with the money they need to buy all those long-term assets we've been talking about in the last few chapters. You think about a balance sheet. Assets equals liabilities plus equity. This one has to do with liabilities. Companies have choices. They can either have the owners kick in more money, or they go out and borrow. So again, we're going to talk about some different ways they can use debt financing to come up with the money they need to finance the purchase of the assets that they buy. We're going to talk about three different types of financing. Today we'll talk about a certain kind of bank loan. We'll start talking about some different bonds, and then we'll finish up with bonds and capital leases on Thursday. But before we get into these different categories, I want to make sure that we talk about some concepts that apply to long-term debt as well as other accounts on the balance sheet. Historical costs we've talked about quite a bit with assets. Many assets go on the balance sheet originally anyway at their historical cost. What it costs to acquire them. Well, it also works with debt as well. Whatever the amount was that you originally borrowed, the historical amount, which we were going to start anyway, it was from the balance sheet value of the liability account. Yes? What's that now? They should be. Third section. What do you think of the third section? I guess just need to go a little bit further. Thanks for the help. The second item that says the concept of a transaction. If you think about your credit cards that you have in your pockets, your credit cards are not debt unless you use them. If you've got a credit card and you never swipe it to buy something, you don't have debt. What you've got is called a line of credit. You've got the ability to take on debt. Companies also have lines of credit. They might go to a bank and ask for the ability to borrow $10 million if necessary. But if they never access the line of credit, they don't have debt. So we've got to have a transaction that actually incurs debt before any debt shows up on the balance sheet. And the last one, matching principle. Bless you. We've talked about what the matching principle is in the context of inventory and property, plant, and equipment. Remember what you're trying to match. You're matching expenses in the same time period as the revenues are associated with. If you go borrow money, what expense will you incur? What do we call the expense that you have when you borrow money? Yeah, the interest expense. So when do you record interest expense? Let's say that I borrow money and I'm going to pay it back in 5 years plus interest. So I've got the money today, I use it for 5 years, and I'm not paying anybody anything until 5 years later. I pay back the money plus the interest. When should I record the interest expense? Not when I pay it 5 years from now. But the matching principle says that you should record the interest expense during that 5-year period that you are generating benefits from the borrowed money. If you borrow money and use somebody else's money for 5 years, you're getting benefits from that for 5 years. You should record the interest expense evenly over the 5-year period, or at least over that 5-year period of time evenly. Okay, so let's talk about the first category of debt that we're going to deal with. It has to do with a certain kind of bank loan. There are lots of different kinds of bank loans you can structure, but we're going to talk about what's known as installment debt. How many people here have a car loan you're paying off? Raise your hand. We have a few of them. And most of you probably have parents or other relatives who are paying off home loans. Those are examples of installment debt, where you make periodic payments, typically monthly, and when you make a payment, part of the payment pays interest expense, and part of it pays off the loan itself. So that's what installment debt is. And that's what we're going to be dealing with in this section of the chapter. When you have installment debt, you get money today. You're going to borrow some funds. And you're paying it off over time in the future. So we've got time value of money issues to deal with. You get money today and you pay it off over time in the future. What we're going to want to be able to do is determine how much should the payments be on the car loan or the home loan or any other installment loan. Well, basically, this is a present value of an annuity problem that we learned about a couple chapters ago. Down here, I wrote in the formula for the present value of an annuity. Present value equals the annuity times this number you look up in the table. Present value of the annuity table. Well, if we're trying to find the annuity, the payment, you can algebraically manipulate this formula, divide both sides by the present value factor, and that's what you get up here. The payment equals the amount we borrow, that's the present value, divided by the present value interest factor of an annuity for however number of periods and whatever the interest rate is on the loan. So that's one thing we're going to ask you to do, to be able to calculate the amount of the payment on installment debt. Here's an example. Citibank is going to lend Sprint $500,000 at 8%, and Sprint will pay it off in quarterly installments over the next 2 years. Now this tells us that the payments are going to be $68,254.73. How did we come up with that amount? How do we know that the payments are going to be exactly that amount? Well, it's the present value of an annuity problem, where the present value is the amount borrowed, $500,000. Something we have to deal with in this chapter that we didn't 2 chapters ago is something called multi-period compounding. Back in chapter 19, when we had you do time value of money problems and net present value problems, all the cash flows were annual cash flows. In this case, we've got quarterly payments. You're going to make a payment 4 times each year. So the payment periods are fractions of a year. In this case, when we're looking up the present value interest factor in that table, even though it says this is 2 years, we can't go to the n equals 2 row. Because really what that n is in the table is the number of payment periods. So we've got 2 years, but we're making 4 payments per year. The number of payments, therefore, was 8. 4 per year for 2 years. So when you use the present value of the annuity table, you want to go to n equals 8, not 2. Also, whenever you see a problem, or a loan contract for that matter, they're going to quote to you the annual interest rate. Sprint Citibank loan says the rate is 8%. That's an annual rate. But what you want to do is you want to use the interest rate per quarterly period. You want the interest rate per payment period. And our payment periods again are quarterly. So if this is 8% per year, that translates into 2% every quarter. That means when you go use the present value of the annuity table, they're referring to n equals 8, I equals 2%. You may have problems that deal with quarterly payments like this one, semi-annual payments, monthly payments. Are there any questions on how you convert into the correct number of periods and the correct interest rate to use in the tables? Okay, so how did they come up with that $68,000 payment amount? They took the amount borrowed, the present value, and they divided by the present value interest factor of an annuity for 8 periods at 2%. And in your table, it would probably be 7.326. Because remember, your table's cut off at 3 decimal points. But that will tell you what the payment should be every quarter. Any question about that? The next thing that we'll have you do in this kind of a problem is the payment is going to be the same every period. Just like those of you who have car loans, you're making the same payment every month. But every time you make a payment, part of it is interest and part of it is principal. So we want you to be able to take the payment, once you found it, and determine how much of that payment is interest expense and how much is paying off the loan itself. Well, the first thing you want to do is calculate the interest portion. And here's how you do that. The interest portion of every payment is equal to, notice it says the periodic interest rate. That means whatever the period is, in this problem it was quarterly, 3-month period, quarterly. They want to know what was the interest rate per 3-month period. And remember, it was 2% per period. And then you multiply that by whatever the amount you owe at the time is. What is the amount of the bank loan? In this problem, we can take a look at the very first payment. The $68,254.73 payment, how much of that is interest expense? You take the amount that you owe, that's what you borrow, multiply it by the periodic interest rate, 2%. So this is saying that of the $68,000, $10,000 of that is interest. Now this isn't added on top of the $68,000. This is the payment they made. And of the $68,000, $10,000 is interest expense. Then the rest is going to be paying off the loan itself. Whatever the interest portion is, you subtract that from the payment that you made to get the amount of the loan itself that you're paying off. To continue on with this particular problem, the very first payment of $68,254, we found out that $10,000 of that was interest expense, and that means the other $58,254.73 is to pay off the loan. If we were to ask you to tell us what accounts are affected and how with the first payment, you would tell us cash goes down by $68,000 and change, interest expense goes up by $10,000, and then the bank loan payable, the liability account, would go down by the difference of $58,000 and some change. Any questions about that? If I were to then go on and ask the question, what is the interest expense portion of the second payment? Can anybody raise your hand and tell us how you would do that? How would you find the interest expense for the second payment? Yeah?
Would you take like what you've already paid minus, like take that away from the principal and then multiply it by 2?
Very good. In other words, this is what we used to owe. But we don't owe that anymore after the first payment. Because of the first payment, this was paying off some of the $500,000. We only owe now $441,000 and some change. So you're saying that find the interest expense of the second payment, take the new amount owed, $441,000 and some change, multiply that by 2%, get the interest portion of the second payment. Very good. Any questions about that? Okay. So one type of debt financing is to go to a bank and take out a loan. One type of loan is installment debt. Another way a company might go about raising money through debt is by issuing bonds. If a company wants $100,000, $500,000, $1 million or 10, they might be able to go to one bank and borrow that much money. But sometimes big corporations need $500 million, $1 billion, or $10 billion. No one bank is going to take on that much credit risk with one customer. And so in order to get that much money, what a company might do is issue bonds in the financial market. I want to go through some of the terms at the top of this page. Basically what a bond is an IOU. It's a piece of paper that says, basically, I owe you so X amount of money, here's the interest rate I'm going to pay you, and this is what I'm going to pay off the loan itself. And then they'll take these bonds and they'll sell them to anybody in the world who wants to buy them. You, me, or anybody else can buy the bond. Anybody here own bonds, by the way? Any bond owners, a few of you? When you buy bonds, you are in effect lending money to that company. They're the ones that are issuing the bonds to you. And you buy the bond, you're lending money to them. So that's what a bond is. And anybody in the world can buy them. That makes the amount of money a company can borrow a lot bigger than they can from just one bank. The face value. That is the amount that the company will pay back when the bond comes due. For most corporate bonds, that face value is $1,000. So for companies to issue bonds, usually at the end of the maturity period, whenever it comes due, for each bond they're going to pay off $1,000. The maturity date is when it comes due. And for most corporate bonds, they are going to issue bonds that come due in 20 years. So they're borrowing money, paying it back in 20 years, and that amount is typically the face value of $1,000. Throughout the 20-year period, they are going to pay some interest rate, known as the contract rate or the coupon rate. So this bond, this piece of paper that says, I owe you $1,000 in 20 years, it'll state on the bond what the interest rate is at the